It's my pleasure to welcome you today to our webinar on asset allocation strategy now and post-COVID, and how it is that we seek and manage to the 3 R's of return, risk and resilience as part of our planning process with our clients. This afternoon, I'm pleased to be joined by my fellow partner, Anne-Marie Tassoni, who is in charge of client management and client strategy. My name is Paul Ashworth, and I'm the Managing Partner and Chief Investment Officer of Cameron Harrison. As private investment managers to private business owners, families and individuals for over 30 years, our partners have a fundamental position that managing and advising on client wealth must have a clear context, frame and agreed set of objectives. Managing in a vacuum just doesn't work, and we will not do it. Today, Anne-Marie is going to share with you our philosophy and process for wealth planning, and in particular how Cameron Harrison explore with clients the asset allocation and the 3 R's of return, risk and resilience. We'll continue with Q&A and of course invite any questions through the chat area. To begin, however, I'm going to outline and share our strategy position and views on asset allocation now and looking beyond COVID through the balance of this decade. Asset allocation is at the core of wealth management outcomes for Cameron Harrison's client strategy. And as the analysis of such learned people such as Paul Kaplan and Roger Ibbotson highlight, asset allocation drives the substantial outcomes for returns over the medium to long run. This is certainly a view and a position that our investment managers hold at Cameron Harrison, and why we put so many resources into our investment and economic strategy. Cameron Harrison's approach to asset allocation is one of a combination of both traditional asset allocation between the asset classes of equities, fixed income, real assets, property and cash, but draws from an analysis of various factors. Some of these factors are credit spreads, political risk, liquidity, inflation expectations, currency, market costs, market risks, macroeconomic policy and settings. And it's these factors measured against the relative opportunity between the basket of asset allocation choices, which drive our balance of risk assessments and allocation between the various classes and subclasses. What I have here is a summary of our asset allocation outlook, divided between the short term through to the end of 2022, which will be a reasonable expectation in terms of addressing the health and economic impact and consequences of COVID, and then the longer term outlook for asset classes based on a post-COVID position through to 2029. For the ease of today's presentation, we've put that into colour coding in terms of the core asset class alternatives. We also have a more specific breakdown within these asset classes in terms of currencies, different types of property, different types of bonds, yields, and geographies of equities, which is available by contacting us. What is most notable or apparent is that which is shaded in green, which is both equities and commercial property, which we are well disposed to both of those asset classes, particularly as the global economy rebounds. This reflects our view that output will recover and get near to its pre-COVID growth rate. But it won't be a straight line, and there'll be fits and bursts. This ought to be contrasted to our view on bonds and cash, which are being deliberately suppressed by government policy and face upside risk to yields and hence capital prices. And the final thing I'd like to note is that in terms of commodities, we're reasonably positive on commodities and commodity-related companies in the short run, particularly as they are tied to government stimulus around the world, but most notably in China. But when we look at this from 2022 onwards, we have a more muted relative position, which reflects the easing of this stimulus. The degree of muteness in our assessment of asset classes from 2022 onwards is across the board. We think this is important to note because these muted assessments are really synonymous with an expectation for lower nominal returns for investors. And secondly, that from a real return perspective, that is adjusted for inflation, the risk of increased inflation will be on the upside, which will dampen real returns. A key foundation to the framing of our asset allocation relative positions over the short and long run is what the output recovery will look like post the COVID asteroid hit. It is clear that there's been a material impact to output, but also that it is not unparalleled from a historical perspective, where we've seen recessions, depressions, financial crisis, and most recently the GFC. The initial COVID output loss will largely be a permanent output loss and won't be recovered. That's in the form of lost consumption from leisure, restaurants, travel, and plain out cancellation of investment and consumption. That said, our view, as matters currently sit and looking forward, is that output will recover and then return to near or its previous growth rate, which in itself was not overly stretched coming into the COVID health crisis. The factors that determine what this output recovery's trajectory will be are firstly the capital stock and how the capital stock is utilised and to what extent any of it's made redundant. Secondly, the labour force and the extent of unemployment and underemployment. And thirdly, how both the factors of capital and labour come together to efficiently operate and optimise output. You can see our view is reflected in the light green line, and that we think that whilst this is stylised and not going to be a straight line, the conditions exist for growth to revert to a reasonable growth rate over the next 2 to 5 years. Importantly, we consider that the capital stock and labour have remained in reasonable condition because we have not had a financial or banking crisis. To the extent that the recovery in output and its growth rate is significant for asset allocation setting moving forward, we wanted to briefly touch on some historical reference events to compare past crises to our current circumstances, and to see how output recovered, taking account of the three factors of capital stock, labour market preservation, and effective coordination. What you'll see is there isn't any guaranteed outcomes. The first slide is the GFC, which is in all our recent memories. The GFC and its aftermath is an example of a relatively poor outcome in terms of the recovery of the growth rate for output. This was largely attributable to a slow and probably inadequate response of fiscal policy and a mixed response by monetary policy other than in the US. What this highlights is the degree by which governments operate austerity in terms of their government spending is very important in terms of how output growth can recover when it's been hit by a shock. Another poor outcome was Britain immediately after World War I and through the Roaring Twenties, which largely bypassed it. This was an example of where government instituted austerity and anemic fiscal support for the economy, which all combined with the imposition of tariffs and protection, which lessened competition and innovation within the economy, together with Britain's reduced market share in terms of commodities and trade items. As we can see, from 1915 to 1950, Britain never recovered to the growth trajectory that it was on prior to World War I. Encouragingly, both these examples can be contrasted to the Great Depression in the US. What we can see here is that once government spending started to loosen from 1933 and monetary conditions became more supportive, that output started to improve and unemployment reduced from a high of 25% in 1933 to a little under 10% prior to the beginning of the US's entry to World War II in 1941. From these examples, we can see that where there has been a significant economic shock, the role of expansionary government spending is foremost, together with supportive monetary policy in restoring growth to output. If this does not occur, or it is curtailed too early, then like the recent experience of the GFC, particularly in Europe, we can expect output growth to be suboptimal. The COVID response and the greater understanding by policymakers to past crises suggests lessons have been learnt from the past and a reasonable basis for output to grow at rates prior to COVID exists. Conversely, were this to prematurely cease before output growth stabilised, then this would be a reason for significant caution and our assessment would naturally change. At this stage, we don't foresee significant destruction of capital stock, but we do acknowledge that for industries like aviation, there may be some permanent destruction. However, this is small in the context of the overall capital stock. This is a significant positive supporting future growth rates. In terms of labour and employment, you can see where consensus estimates sit. From peak unemployment over the next few months, there is likely to be a substantial fall in unemployment from mid-next year, moving to levels well below 10% from 2022 onwards. This is also consistent with outcomes in China. This is supportive of future output growth rates. In terms of labour, I would make a specific note in relation to Australia, and that is that we have had the highest net migration per head of population for the last 5 years around the world. This has boosted economic growth, added to government tax revenue, and significantly increased the size of the working age population compared to the population over 60 years of age. If this were to be curtailed, then this would adversely impact economic growth in Australia compared with the pre-COVID period growth rates. I'm mindful of time today, but would like to give some brief insight into our relative views on specific asset classes. In terms of equities, last month we provided our views on global equities, specifically in the context of the preoccupation of markets with a handful of named tech companies. We noted that exposure to profitable, well-run technology and innovation is being ignored by the marketplace, which is fixated and preoccupied with this small group. On the basis that we see a recovery in output and a reasonable trajectory in output growth rates, we restate our preference for quality, dynamically conducted business that represent reasonable value, averaging between 7 to 18 times cyclically adjusted PE earnings. We can see the relative underperformance of these companies relative to big techs and the FANGs. The same is true in Australia, if perhaps on a somewhat weaker basis, due to Australia's level of household debt and consequently constraint on consumption and investment moving forward. In terms of listed property or REITs, both here and in the United States, we find this class attractively positioned, particularly relative to the equities recovery over the last 2 months. For an Australian context, we are long positioned in logistics assets, industrial, office, and quality fringe CBD. We're invested on long-weighted average lease expiries, or in shorthand, WALEs, of over 6 years. The exposure is to investment grade and government tenants. Gearing is at 30% or lower, with long debt expiry duration. There's been negligible COVID rent adjustment, and prospective forward yields are 6.5% to 7%. This sees a relative upshift in property at the expense of fixed income. The comments last week by Federal Reserve Chairman Jerome Powell supporting a higher than target level of inflation being allowed to exist is supportive of the strong operational businesses that we have within the Cameron Harrison global equity and Australian equity strategies. From a bonds perspective, against an upward inflation risk bias, medium to long-term bonds face upward yield pressure, and as a result, pressure on their capital prices, which have over the last 30 years benefited from the compression in bond rates and capital price appreciation. Accordingly, we favour exposure to financially secure corporate debt with low duration within the fixed income spectrum. Finally, I will leave you to consider projected asset class returns over the remainder of the decade. As I've noted here, it is akin to rubbing a crystal ball, and the path over the next 9 years will be far from steady nor smooth. But what it does clearly show is that the 30-year bull market in bonds and fixed rate securities without any inflation hedge is over. As we've consistently commented on over the last few years, the journey ahead is not simply a set and forget passive path dictated by ever-compressing bond rates. That chapter has concluded, and we return to more uncorrelated outcomes amongst asset classes. Asset allocation will require greater attention and a more dynamic approach by investors. So how is it that Cameron Harrison translates this asset allocation strategy into invested client outcomes? For that outcome answer and more, I'll pass over to Anne-Marie Tassoni.
Thanks, Paul. For those of you watching who I haven't met, I'm the Director responsible for Client Wealth Management. And today I will take you through how we address strategy with clients. A client's success or otherwise in achieving their wealth goals is highly dependent on the investment strategy chosen, and in particular, asset allocation strategy. Our role as advisors is to assist clients through this process, which is always specific and appropriate to their individual position. The setting of asset allocation is a core element of wealth strategy and flows from a clear, well-considered framework of objectives. We advocate regular review of objectives rather than the set and forget trap many unknowingly fall into. When should a client review their objectives and asset allocation? When engaging us for the first time, this investment strategy setting is the first decision we'll ask them to make. They may have experienced some form of capital realisation event, such as the sale of a business or significant asset. Conversely, they may have committed some of their existing funds to another investment opportunity, such as the purchase of a property, and need to rebalance their portfolio to accommodate that new exposure. Life, as we know all too well over the last 6 months, throws curveballs, and our work, family, and funding circumstances change. Economic circumstances also change. For example, perhaps the client's priority is for income, and low interest rates warrant a move towards high earning asset classes. Or maybe an uncontrollable influence has tested their existing strategy and proven it to be at odds with their underlying risk tolerance. Certainly the last two reasons for needing to revisit investment strategy are highly relevant in the current COVID environment, and is the most common reason why clients have asked us in the past few months, is my strategy still right for me, or should I be doing something different? Regardless of the reason why a client would want to revisit their strategy, we take them through our strategy review process. The process itself is quite structured, but of course the outcomes are different from one client to the next. So let us take you through our approach to client strategy, using Michael and Michelle as our case study. We start first with their current financial position, their assets, liabilities, income, and expenses. Our approach to asset allocation is needs or objectives based, meaning we seek to balance the client's strategy with what they need at a core level. Often we find the question, how much do you need to live off, is the most difficult question for them to answer. But through a number of questioning techniques, we listen and probe until we get to that realistic figure. It's why the investment strategy process is equal parts analytical as it is behavioural. In Michael and Michelle's case, they're in their late 40s and their commitment to school fees is coming to an end. They are earning more than they need to meet their expenses, so they have no need for income from their investment portfolio. And consequently, they've been able to accumulate $3.5 million of net assets to date, which is currently invested to our core strategy of 50% exposure to market risk assets. So we now know who they are, but what are they about? What's important to them? To be able to construct a strategy with purpose, we need to understand what their priorities are. And to do this, we asked Michael and Michelle to identify their three most important objectives, which today are to increase their pool of wealth over the next 15 years before they retire, enjoy a lifestyle that allows them to travel with their family while their children are still young enough, and to continue to support their children financially through tertiary education, and perhaps at a point in the future to be in a position to provide them with some financial assistance for their first property. This part of the process is not always straightforward, and sometimes we see quite divergent priorities between family members, which we need to balance, but can be addressed through a risk pools approach. Before we can advise Michael and Michelle on a specific investment strategy, we need to truly understand what drives them. In other words, to understand their psychology. If we don't get this fundamental understanding, we find it inevitably leads to misaligned expectations. Here we consider their capacity to take on risk, their willingness to take on risk, and their behavioural and emotional influences. For example, a client may say they're willing to take on risk, but then they get very anxious when markets fall, which would indicate an overconfidence in their personal risk assessment. Questions we might ask Michael and Michelle in understanding their respective and joint profile would be, are you seeking capital growth, capital preservation, or income? Would you prefer that your portfolio grew at, say, 6 to 8% with a degree of consistency, or at a higher level with a higher chance of low or negative return? When markets go down, do you tend to want to sell your riskier assets, your shares, and put the funds in lower risk assets such as cash and term deposits? Do negative short-term movements in asset prices significantly influence your ability to stay exposed to those assets? We're now starting to form a picture about their risk profile. We know the traditional risk-return trade-off would likely require more risk to be taken in order to achieve higher returns. So we start with the base risk-free position, move up that curve until we meet an asset allocation that satisfies both their risk and return parameters. Importantly, we consider if an investor could achieve their core objective through, say, inflation-linked government bonds, why should they take on any more risk? In the Cameron Harrison asset allocation suite, interest-bearing securities is our base position. Now for Michael and Michelle, they have both a capacity and willingness to take on risk. Capacity in the sense that they have stable income from other sources that meets their expenditure without drawing on their existing capital. Willingness in the sense that they want to accumulate for their retirement, which is at least 15 years away, and they therefore have a sufficiently long investment horizon to accept some variability in returns. We note that Michael and Michelle's existing core strategy of 50% market risk assets is too conservative relative to their current risk profile and objectives. So we consider a move up the curve to either moderate, 60% market risk, or growth, 70% market risk. Technology is a powerful aid here, and we have developed our own portfolio modelling software to add science to this process. The Cameron Harrison Asset Allocation tool is a client-driven and interactive tool to simulate potential future outcomes for a range of variables. This was custom built by us in conjunction with a New York-based software designer who has worked with the World Health Organization on dynamic modelling. And we are pleased to share this with you today. Simulating Michael and Michelle's options with the tool, we enter their key input assumptions: portfolio value of $3.5 million, and an investment time frame of 20 years being their likely retirement. We then set up the two scenarios. Scenario A being the moderate strategy, and scenario B, the growth strategy. The tool then runs what's called a Monte Carlo simulation, which involves 1,000 simulations over the 20-year timeframe. The result is shown in the chart on the right. The green line is scenario A, the moderate strategy, versus the grey line, scenario B, for growth. Not surprisingly, the growth strategy produces a higher future portfolio value than the moderate. Of course, return is not the only factor. The variability of returns should also be expected to increase with return, and this is shown by the shaded areas around the lines. The lines themselves show the most likely portfolio value for the simulations run, whereas the shaded areas show the range of possible values. You can see from the chart that the higher risk growth strategy, the grey shading, has a larger range of possible outcomes than the green moderate strategy, indicating the additional variability or risk associated with higher growth. The variability becomes more pronounced the longer the investment time frame. Now, what about those inevitable but often ignored troughs? How would Michael and Michelle react if their portfolio didn't always go up? Loss frequency is the chance of a negative return in any 20-year period. For the moderate strategy, the loss frequency is 3 years in every 20 years. For growth, it is 4 years in every 20 years. Armed with all that information and with the benefit of visual simulation of possible outcomes, Michael and Michelle understand the balance of risks and the higher chance of experiencing the negative return frequency. Consulting with us, they opted for the growth strategy. But as is our diligent and disciplined way, we navigate this move on a staggered basis and advise them to first move from core to moderate, increasing their market risk by 10% over the next 10 months. Then we will reassess. We will likely remodel, and if the environment and their circumstances continue to support it, we will embark on the next move to growth.
Asset allocation strategy and its integration to client strategy outcomes is Cameron Harrison's central activity and focus. We thank you for your time this afternoon and trust that you have found the research and how we bring to life asset allocation for clients of interest and value. Above all, it is a constant, reiterative process. There is no set and forget. As always, I encourage you to reach out to your director, and of course, I'm always available for any query or question. Keep well, keep safe, be strategic in your wealth management. Thank you.